participated, all of us who are involved with Venture Mechanics have participated as founders, as investors, as mentors, as incubator operators, and all the other different schemes out there, like Techstars, Y Combinator, et cetera, some specialized ones in the CPG industry and so forth. And the situation's always the same. The incubators, accelerators, you see a lot of these business plans where they say, oh, we have already done 4 accelerators and we've applied to 2 more. And I shake my head and go, why? You should be one and done. If you go into an incubator accelerator, you should be funded on the way out. That's the biggest distinction in what we do here. Is the catapult metaphor here is you get launched. And not only that, as you saw in some of the slides, we are working on your next round, as well as the next one in many cases. I'll bring a little bit of my aviation background into this, is that years and years of studying aviation statistics. So Brad, number 1 reason that a plane crashes?
Pilot error.
Pilot goes into weather beyond their capability of that of the airplane, right? Number 2, fuel exhaustion. They forgot number 0, didn't have a co-pilot. They had a co-pilot, order of magnitude difference in accident statistics. The equivalent here is what I've observed over the years, both in my own companies I've invested in, companies I've incubated. Number 1 cause of crashes of startups between round 1 and round 2 is they were torn between spending time on raising capital, spending time getting the numbers to go up and to the right. If you don't do that, you can't raise capital, and if you can't raise capital, you can't get the numbers to go up and to the right anymore. And so we try to eliminate that by lining up first the Series A investors, and then we can tell the seed investors, and then in some cases a pre-seed investor, hey, there's already one who's interested in this deal if you can bring it to their threshold. It also improves our due diligence process, but it lowers the risk for that pre-seed and seed investor, the highest risk investors, that you won't get your next round of funding and then they're a complete write-off. And that is actually the most common reason that startups fail, is they fail to get the next round. Wasn't necessarily a product market fit issue, or they didn't pivot right or whatever. They run out of money at some point. And so we structure things very differently. So first, not to speak ill of the competition, but this is what they do. This is what I experienced as a mentor. It's all a 90-day cohort. Come in on this date, you'll leave on that date. Whatever you got. You sprinkle you with mentors, sprinkle you with a few investor meetings, and then the next thing you know is they're on to the next accelerator because they didn't complete their funding. I see this every single day. They do take a huge equity grab. Why? Because the second to last bullet there, their whole business model is based on a 3% unicorn rate making up all their money, and that's where Techstars collapsed on February 21st, is you can't always count on that in every market. And when there's a cataclysmic market event every 6 to 10 years, your economics go upside down. All of a sudden, venture capital's got negative returns for 2 years. They can't raise their funds, and so they're not supporting all these spray and pray investments that they made when the money was good. But the mentors are not coordinated. That's what I noticed. I was a mentor in the first year of Founders Institute, Techstars, all these others. You talk to one mentor one day, and the next day another mentor comes in. They can be completely contradicting. They can be completely redundant, but what they're not is comprehensive. So what we do here with our teams is we augment the teams, where we put them through finishing school, basically, so that they are fully trained on how to run a venture-backed company, and they're fully equipped to do so. And that's not something I've seen any place else do. So we are asynchronous, first of all. We bring a company in when they meet a very high threshold. That threshold is, so to bring Joshua into this deal, I literally call 20 investors. I say, here's his idea. It's GitHub for non-software engineers. Usually a 20-second conversation before they said go. Right? And they know that if we take the company in, we're going to make sure that the due diligence and the customer discovery and the budget models and the exit strategy and all that is world-class. And that when we call them in to meet with the founder, they're going to be able to build a relationship. If you were in the earlier session here with angel investors, they were talking about, I hear this all the time, I don't want to meet the founder when they're putting the term sheet in front of me. I want to meet them months earlier. I want to get to know them. It's part of our dual citizenship program with Alliance of Angels has worked out so well, as we create a possibility for AOA members. We're going to have a cut line of 30 companies for 1,000 applicants, right? To come and see these companies earlier, these founders earlier, get to know them, and then call them up and say, hey, the term sheet's ready. And we do support them here as long as it takes to get their first funding round, but we do expect that most companies are actually going to stay in, because the second you pop the cork on the champagne, you got your funding closed, and the following morning you are fundraising again. Any serial entrepreneur knows this. It's a nonstop process, and we carry them all the way through that. We assign a quarterback to each deal. So Greta is the quarterback for consumer CPG. That's how she got involved with us. Next thing you know, she's also our CMO. Amazing. But 20 years ago, we were in Keiretsu, and she was running the CPG selection process, due diligence committee. And so the quarterback, she came here and saw how we do things. Like, wow, it's a much higher success rate. So for mentors, and mentors to become quarterbacks, or super, super duper mentors, they know there's a very high rate of success here. It's worth investing a lot of sweat equity into these companies. We're going to see it come back, because they will get funded. But we do have this process called the conclave, and what we've learned over time is that this sharpens the focus. So classic, I will say not stereotypical, absolute consistency. Entrepreneur or 2 or 3 founders come in, and they are absolutely paralyzed in indecision. They have been told this by one investor, this by another advisor, this by their spouse, this by a customer, and they're perseverating at night. Do I go B to B? Do I go B to C? Do I do a safe? Do I do a convertible note? Whatever the issue is, they've been given conflicting advice. And I've lived this many times, and what we have figured out by building teams of mentors is an incredibly empathetic process. So that classroom up front there, a couple weeks after a company comes in and they're prepared for their conclave, they are at the podium, and up to 15 mentors are in seats, maybe more on virtual. And that whole evening, we are practicing creative destruction on their business plan, but coming out with incredibly sharp focus. And it's always the same. What's going to be your pre-seed round? What are your beachhead markets? That defines your dev budget, that defines your marketing budget, your goals that you're going to need to meet. What's your next round going to look like, and what are the beachhead markets there? And again, that defines all. The next 2-3 months are just going to be validating their customer acquisition costs, their payroll, all those elements. How much are they going to have to put into dev, and so on. So that process, that first initial conclave, that just sharpens the focus. So now they're hitting the ground running the next day. They know exactly what they're building towards with their budget model. And actually, that process actually begins even earlier with an exit strategy. And this is something that YC and Techstars have explicitly told entrepreneurs not to do anymore. And I think that's a crime against humanity. If you get your MBA and you take a venture capital class, they're going to tell you know your product, know your market, know your exit strategy, basic 3. And so we really believe that it's critical. For example, with Joshua's company, one of the first calls I made was to Siemens, which now owns 40% of the CAD market. Right? They've been rolling up a $5 billion division. They went bananas when they heard about this. Like, their job is to give away their software, like Azure and AWS, give away credits to startups to try to get people hooked on their stuff. So knowing that Siemens could be an acquirer can completely shift, as Joshua hinted at. What if we focus on mechanical engineers, because Siemens comes along and says, we'll skip your first round, we'll sponsor you, right? We want to get in front of all those engineers. So we think it's really important to do that stepwise, starting with the exit strategy, and that's something you saw on all 3 decks. Catapult companies is that exit strategy there. I went to the last Techstars 23 companies, no exit strategy slides. So in between, I'll show you in a moment here that the 10 classes that we have put together. The founder workshops are highly interactive. Small groups usually, maybe 15, 20 entrepreneurs, the whole evening on one subject. These are the 10 most important subjects. And so every Catapult member goes through that, but we open that up to the outside world. So a lot of people come into the Catapult actually after starting with the classes, the founder workshop classes, and those are taught by our top mentors. The final conclave is interesting. We ask people to channel the biggest assholes they've ever pitched to. Come in the room, and we've all been there, right? There's one guy who asked the asshole question at an Alliance Angels meeting that turns the whole energy off, right? So I call prepping for the presidential debates, but you've already been pitch coached, your deck is done, everything's ready to go. Tomorrow morning, we're going to give you a list of investors to go meet with, but the last thing we're going to do is practice, jujitsu maneuvers when you get those questions. So we literally come And so that after finishing school, what happens then is, like I said, they're fully trained, they're fully augmented, whether it's board members, advisors, management. If you were in the prior session on fractionals, you heard all about how fractionals have truly become the enzyme that runs the organism at this point. And then we have events like this. We have lunch and learn deep dives for the companies, and we have one-on-one investor pitches. We set them up. They have to do their own pitches. We are not broker-dealers. We're not in the middle. We're just guiding them. But we're creating those many opportunities for them to come up and practice, like you saw today, before they get up in front of VCs and angel groups. And so, yeah, these are the classes, by the way. And the next one, Customer Discovery, is on Tuesday. Angie and Catherine teach that one. Our most popular because we send the most entrepreneurs to that one because they need to do more work before we even consider them for the catapult. That's very typical. But you get a sense of what those are. They don't have to be taken in sequence, but they rotate every quarter. And then my last slide here, I think, before I let them get up here and speak to you, what it takes to get accepted. So I developed a deck 25 years ago with Sequoia Capital. They're still using it, I'm still using it, and I send it out to any entrepreneur who wants it, and every slide is in the form of a question. Fill out as best you know. What are your per customer economics? What's your IP? What's, every question, typical deck, and then we evaluate that. We do, we call it a colonoscopy. I think I labeled it endoscopy here to make it a little cleaner, but we really do more due diligence than any pre-seed investor is ever going to do. Before we take a deal on, we're going to get investors to sign off on it. We need to be comfortable with it. But it gives us an idea of where do they need help. And we have a couple of hundred mentors that we can apply. We want more mentors because getting an insurance expert like Andrea is fantastic, but there's insurance for healthcare, there's insurance for property and casualty, there's all kinds of insurance out there. So we're always looking for more mentors, but that's when we set up the conclave. We send out Sign Up Genius. There's 15 slots, 10 slots we pick together. These are the mentors we got to have. For Jerry, we were trying to get an insurance expert, and we couldn't, but now we've got some people coming in later now. We try to get as many of those experts in there as possible. And the most amazing thing to me as we were experimenting with this is how empathetic the process is. First of all, the mentors are really, really good at, when they're in front of each other, they behave well. But they're listening really, really well, and they're really building on each other's expertise and helping the founders vet through all those perplexing choices that they have to make. And so it typically takes about 5 to 8 months to go through the process. But we're in it for the long haul with the